Welcome to your daily solo 401k webinar and Q&A session with my solo 401k financial, where we help you to stop overpaying taxes and start building real retirement wealth. Today's topic: why the solo 401k beats the SEP IRA. So this is your chance to get answers. Use the chat to ask questions on today's topic or anything else. Type them over now so that we can be sure to get to them all. Let's get started here. So before we start talking about why the solo 401k beats the SEP IRA, let's first understand the eligibility requirements to open a solo 401k plan. So a solo 401k is for the self-employed who does not employ any full-time non-owner W-2 employees who work 1,000 hours or more in their business. So it's not necessarily the type of entity that determines if you can open a solo 401k or not. For example, your self-employed entity can be an LLC, an S corporation, a partnership, a sole proprietorship, even a Schedule F if you're a farmer. So it's not the entity type that determines if you're eligible to open a solo 401k, is rather the underlying activity, the actual work being performed. So you have to be performing material services. So you have to be working, in other words. It cannot be investment income, passive income, or capital gains income. That's not considered earned income from self-employment activity. So it's important to understand when exploring whether you want to open a solo 401k or not, or even a SEP IRA for that matter, is you have to be doing self-employment activity. You can exclude individuals who are under age 21, even if they work 1,000 hours or more. So even if you employ someone who's working 1,500 hours and they're only age 19 or 20, you're still going to be able to open a solo 401k, because under the solo 401k rules, you can exclude those who are under age 21. All right. So let's keep on talking about today's topic, which is why the solo 401k beats the SEP IRA. So some of the items we're going to be covering today are why a solo 401k lets you contribute more money faster, even at lower income levels. So let's talk about that topic. So with a solo 401k, you can make various contribution types. You can make employer, also known as profit sharing contributions. You can also make employee contributions, also known as salary deferrals. And you can also make catch-up contributions. With a SEP IRA, on the other hand, you can only make employer contributions. So that's one of the ways that a solo 401k beats a SEP IRA, that is, from a contribution perspective. For example, for tax year 2025, you can make an employee contribution to the solo 401k of $23,500. Well, a SEP IRA does not allow for employee contributions. Therefore, you are limited from making that $23,500 employee contribution to a SEP IRA. So you're not able to make a contribution of that type, an employee contribution to a SEP IRA. Now, a solo 401k also allows for employer contributions. So right there, if you're exploring whether you should open a SEP IRA or a solo 401k, and you're solely looking at it from a contribution perspective, then it's quite obvious that the solo 401k is going to be the best retirement vehicle for those who are owner-only businesses, because you can make both employee and employer contributions to a solo 401k. Now, there's the catch-up contribution for those who are age 50 or older. You can make a $7,500 catch-up contribution to the solo 401k. Well, that's not allowed for a SEP IRA. For a SEP IRA, if you want to make a catch-up contribution, you have to make it to a traditional IRA, and the limit is only $1,000, for example. Now, the solo 401k also allows for a super catch-up contribution, resulting from the passage of Secure Act 2.0. It's available for those who are age 60, 61, 62, or 63. Those individuals can make a super catch-up contribution of $11,250. You obviously can't also make the $7,500 catch-up contribution. So it would just be the super catch-up for those who fall within that age range. Well, SEP IRAs do not allow for super catch-up contributions. And then, of course, another big factor is that a solo 401k allows for voluntary after-tax solo 401k contributions as part of the mega backdoor Roth. A SEP IRA does not allow for voluntary after-tax contributions, and therefore no mega backdoor Roth. Yes, a SEP IRA may be able to do a backdoor Roth IRA conversion, but that's a whole other topic, and we've actually covered that topic in past webinars. But it's still not as easy as it is if you utilize the solo 401k for a mega backdoor Roth. So let's keep talking about the mega backdoor Roth. So again, it's not allowed in a SEP IRA. It is allowed in a solo 401k plan. So the mega backdoor Roth strategy is a way to essentially get more Roth 401k money in your plan above the typical Roth solo 401k limit. So it's a strategy that will get you to get more Roth solo 401k funds in your plan. And the way you do that is there are a couple of ways you can approach it. One approach is you can decide to just simply make voluntary after-tax solo 401k contributions to that solo 401k up to the overall limit, which for tax year 2025 is $70,000. So you could, let's say your self-employed business is taxed as an S corporation. You can choose to make the entire overall contribution limit of $70,000 for tax year 2025 to the voluntary after-tax solo 401k bucket. So this bucket right here. So if you look at the image on the right, you'll see that this is an example of a one participant plan where it's an owner-only business. There's only one owner, there's no spouse, just the one owner. So that solo 401k plan is sponsored by the business. So let's say your self-employed business is taxed as an S corporation. So the S corporation would sponsor a solo 401k plan. You would set up a solo 401k plan that allows for various contribution types. Pre-tax solo 401k contributions, which encompasses both employee pre-tax contributions and employer pre-tax contributions. And then there's the Roth solo 401k bucket, which allows for employee Roth solo 401k contributions, as well as employer Roth solo 401k contributions. That's another regulation that resulted from Secure Act 2.0, where now you can also make employer Roth solo 401k contributions. And then the third bucket would be used to make voluntary after-tax solo 401k contributions. So that's part of the mega backdoor Roth strategy. So back to the S Corp example, you obviously need to make sure you pay yourself enough earned income from your self-employed business to be able to maximize the full $70,000 contribution. So if your self-employed business is taxed as an S corporation, let's say you pay yourself the required amount to get you to the overall $70,000 limit contribution for tax year 2025. So you would pay yourself a total of 70,000 of W-2 gross wages from your S corporation. The voluntary after-tax solo 401k contribution is a dollar for dollar calculation, hence why you would only need to pay yourself a minimum of $70,000 to be able to fully contribute the overall limit of $70,000 to that voluntary after-tax solo 401k bucket. It would then get converted to the Roth solo 401k or the Roth IRA, resulting in getting a total of $70,000 in Roth solo 401k funds. So that's how the mega backdoor Roth strategy works, which again is not available with the SEP IRA, but it is available with the solo 401k plan. Now, as we've been discussing, not only can you make the voluntary after-tax solo 401k contributions, but you can also choose to still utilize the mega backdoor Roth strategy in conjunction with your pre-tax solo 401k contributions, meaning that you could decide to break up that $70,000 overall contribution limit into separate amounts. In other words, you could contribute some as an employee or employer pre-tax contribution, so you get some type of tax deduction for the year, and then you can contribute the difference up to the overall limit of $70,000 to the voluntary after-tax solo 401k bucket, and then convert it to the Roth solo 401k or the Roth IRA. So this here's an example of someone who's under age 50. They're self-employed in an S corporation. They pay themselves $70,000 of W-2 wages. They could make an employee contribution of $23,500. They'll get a tax deduction for that if it's made as a pre-tax contribution. They could then do an employer contribution of 25% of that $70,000. And then they could do the difference up to the overall limit of $70,000 as a voluntary after-tax solo 401k contribution and convert that amount to the Roth solo 401k or the Roth IRA. So as you can see, you can get really creative and you have more choices with the solo 401k from a contribution perspective over a SEP IRA, which only allows for employer contributions. So if this information is helping you feel more confident about your future, please take 1 second to like and subscribe. It tells the platform that this information is valuable, which helps other solopreneurs like you to find it. Subscribing also guarantees you get notifications of all our crucial content that we deliver every day to help you secure your retirement. For example, you can subscribe to our YouTube channel where we have over 950 videos on solo 401k topics. You can also join our community, which is the My Community, with over 30,000 members, especially if you're a financial professional, whether a real estate agent, financial advisor, CPA, attorney, real estate agent, insurance agent, and so forth. You can post guest blog posts on the My Community so you can cover what services you provide, so you can get your work in front of the 30,000 plus eyeballs on the community, and then you can also link it back to your company's website, so that way the members can choose to visit that site if they're interested in your services, and it's free to join. Okay, let's continue here. Again, go ahead and type over your questions during today's daily webinar, and we'll pause and answer those questions as they come in. For now, we're going to continue discussing why the solo 401k beats the SEP IRA. So besides from a contribution perspective, from a mega backdoor Roth perspective, with the solo 401k, you can also access solo 401k participant loans. It's prohibited to borrow from an IRA or a SEP IRA for that matter. That's one of the big differences between a solo 401k and a SEP IRA. It's from a loan participant side of things. So when you borrow from the solo 401k plan, you're effectively borrowing from your own account, from your own 401k. So obviously you have to have funds in your solo 401k in order to borrow. And you can fund that solo 401k by transferring IRAs, even a SEP IRA or a former employer plan to that solo 401k. And that's a way of getting more funds in that solo 401k so that you can borrow through a solo 401k participant loan. There's no credit check when you borrow from your own solo 401k. The interest rate is typically the prime rate plus 1%, or you can use a CD rate, a competitive CD rate plus 2%. Payments are fixed, consistent of interest and principal over the life of the loan. They're typically monthly or quarterly fixed payments. The typical loan term is 5 years. However, there is an exception to the 5-year term if you use the proceeds towards the purchase of your primary residence. And if you use the proceeds, the solo 401k participant loan proceeds towards the purchase of your primary residence, the loan period can be extended to 15 or 30 years. So you have to make scheduled payments over that period. So it's not like you can wait to start making payments 5, 10, 15, or 30 years later. No, you got to start making payments monthly or quarterly after you process that loan. You also have to have a loan payment amortization schedule drafted with the solo 401k loan note. Clients of my solo 401k financial will draft those loan documents at no additional cost. Then you can borrow 50% of the total balance not to exceed $50,000. So for example, in order to borrow the full 50,000, you're going to need at least 100,000 or more in your 401k, your solo 401k. Another example, if you only have $50,000 in your solo 401k, the maximum you can borrow would be $25,000. And again, we'll draft those solo 401k participant loan documents. Now, another advantage of the solo 401k, why it's better than a SEP IRA, is that it allows for alternative investments. Yes, a SEP IRA also allows for alternative investments. However, you have to typically open up a self-directed SEP IRA, or if you truly want to have control over that SEP IRA, you're going to have to create what's called a checkbook SEP IRA LLC. But whereas with the solo 401k, it comes with checkbook control already, meaning you are the trustee of the plan. You can make investments by wire or by check, and alternative investments like real estate, private lending, venture capital, private equity, promissory notes. You can even invest in cryptocurrency, precious metals as well. It's another big one. Of course, the solo 401k also comes with the auto contribution credit, which is not allowed for a SEP IRA. So that's probably one of the biggest monetary differences, because a credit is a dollar for dollar credit. So the government is essentially subsidizing the cost of having a solo 401k plan for the self-employed for many years to come. Probably because there's a saving crisis here in America. And on top of that, the Social Security fund is dwindling quickly. So I'm not surprised that the government has decided to provide this auto contribution credit to solo 401k plans to encourage the self-employed to start saving for retirement through a solo 401k plan. And it's a dollar for dollar credit equal to $500, excuse me, equal to $500 per year for a total of 3 years. So that's a total of $1,500 over a 3-year period. You must open a solo 401k plan from a provider that provides a plan document that has that auto contribution credit built into the plan, along with the applicable schedules. Here at my solo 401k Financial, we provide such a plan. Other providers like the Fidelities of the world, Schwab's, Chase Bank, Wells Fargo, Ascensus, T. Rowe Price, you name it, they don't provide a solo 401k plan that comes with the auto contribution credit. It's available to both new clients as well as existing clients. The auto contribution credit did not become available till January 1st of 2024. So if you're a client of ours to sign up for a solo 401k plan prior to January 1st of 2024, we can amend your plan and add the auto contribution credit to that plan so that you can start claiming that credit now over a 3-year period in $500 increments over a 3-year period for a total of $1,500. You can submit a support ticket if you're an existing client so that we can add that auto contribution credit to your plan. Let me share that support ticket. There it is. Now, what's great about the auto contribution credit, as you're going to find out, is that once it's added to your plan, that doesn't mean you have to contribute to the plan. You can actually opt out of contributing, and you can still contribute in whatever amount you want to contribute up to the overall limit for the year. So in short, even though it's called the auto contribution credit, you're not required to contribute to the plan in order to qualify, and you can still contribute if you have the necessary self-employment income activity and the wages to support the contribution. So it's a slam dunk. You don't want to leave free money on the table. And again, with this auto contribution credit, the cost of having a solo 401k plan is covered for many years to come. And again, because it's a dollar for dollar credit, it reduces your taxable income on a dollar for dollar basis on the business side. You're going to file Form 8881 each year for a total of 3 years to claim that $500 auto contribution credit each year over a 3-year period for a total of $1,500. The form itself is not very tough to fill out. It's a 2-page form. There's only a certain section that needs to be filled out. You attach it to your business tax return, and that's it. We do have a PowerPoint and a video walkthrough that we can share with you, and you can share with your CPA as well. So that's another huge difference of why the solo 401k beats the SEP IRA. So go ahead and submit a support ticket. If you are an existing client, we can add that to your plan. For new clients, we automatically add that auto contribution credit to the plan. All right. So I don't see any questions at the moment. We're almost done here with our daily webinar for today. We've been covering today's topic at great length. So the topic has been why the solo 401k beats the SEP IRA. Now, what we're going to do here is we're going to wait a couple more minutes here to see if there are any other questions. In the meantime, let's talk about a few other items here. So here at my solo 401k Financial, we are obviously solo 401k providers, as our name implies. We've been in business since 2009. So we've set up thousands of these plans, and we provide ongoing compliance support as well for the solo 401k that we offer. For example, a solo 401k is subject to Form 1099-R reporting when you process a distribution or a conversion, or if you transfer funds out of the plan to an IRA, for example. That's going to require the issuance of a Form 1099-R. We'll issue that Form 1099-R at no additional cost for clients who timely request it. Same thing with Form 5500 Easy. That's an annual informational return. And that applies once the market value of your solo 401k plan is greater than $250,000 or at plan termination, regardless of value. And at my solo 401k financial, as long as you timely request that form, we'll also prepare and file that for you at no additional cost. We'll also assist clients in opening up their holding accounts for the solo 401k at their local bank or brokerage firm of their choice. That's one of the reasons we're so popular for solo 401k plans. That is, we allow you to choose where to hold your funds at. Okay, well, I don't see any other questions. That's it for today's solo 401k session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building this community. We'll be back again tomorrow. Until next time, have a great rest of the day. Oh, it looks like we got one comment here that snuck in. It says, is it here at 10 a.m., 1 p.m. webinar the best site to ask our questions rather than calling the office with nobody answers? Great question. So yes, you can schedule your calls with us. We don't have a 1-800 hotline. So here at my solo 401k, we don't hold your funds. We take care of the compliance, reporting, and consulting. So it's not a 1-800 call center, but you can certainly schedule calls. You can also email us your questions. You can attend daily webinars like this to ask your questions. All right. Thank you so much. Until next time, have a great rest of the day.